Hi there, this is Keith Singer of Singer Wealth Advisors. I want to talk to you about where is a safe place to put your money. We've just been scared by the prospect of a couple of banks failing. And for a few days, depositors in those banks were nervous they lost potentially millions of dollars because their banks went out of business. So what makes banks go out of business? Well, here's the thing that people don't really understand. When you put your money with the bank, you're essentially lending your money to the bank. And now what they're going to try to do is make more with your money than they're paying you. And that's how they make their profit. They're either going to lend it out to somebody or they're going to invest it. So in the case of SVB Bank, they had a bunch of startup companies as their main clients. And those companies use them as their bank, depositing their money there. And the bank would then lend out the money or try to invest it in supposedly safe investments like treasuries, which is lending money to the government. And if you lend money to the government, they're always going to pay you back. That has no credit risk, but it does have interest rate risk. So let's assume you were collecting deposits and paying no interest because interest rates were zero. And you said, all right, I'm going to make 2% on this money by lending this money to the government for 10 years. And they're going to pay me 2% a year. So I'm going to make 2% a year on all this money that I've just collected. Nice profit, right? But what happens? Interest rates rise, and all of a sudden people want their money because they need it, or they can go buy treasuries and make 4.5%, 5%, and they want their money back. And now you're this bank and you have to give them their money back. The problem is when you invested billions of dollars in US treasuries that were paying 2%, and now they're paying 5% or 4%, and you need to sell them to pay the money back, you're going to sell at a big loss. And when you sell at a big loss, all of a sudden you don't have enough money to pay everyone back. So that's what happened. The regulators came in and took control of the bank. And don't worry, your first $250,000 is protected under FDIC insurance, which is indirectly backed by the federal government. Unfortunately, many depositors, many big companies who were depending on getting their money back to pay payroll for their employees had way, way more than $250,000, in some cases, hundreds of millions of dollars in their banks that wasn't protected. And so the FDIC said, okay, this could be a major shock to the economic system. This could be a major threat to our system. We're going to invoke this special clause that this is a very special situation that could potentially harm the economy. And we're going to allow FDIC to give everyone all their money back. Crisis averted until the next time when they don't invoke that clause. So now people are worried, well, what if my bank goes out of business? What if my bank makes bad investments or bad loans? And that's a real concern. So if you don't want to have the credit risk of a bank, don't give your money to a bank. Give it directly to the federal government. Buy US treasuries. Open an account at a major brokerage firm like a Schwab or a Fidelity and buy short-term treasuries that as of mid-March are paying almost 5%, 4.9, 5% interest. No credit risk of default. And the nice thing about brokerage accounts is that when a brokerage company goes out of business, that's not their money. You're not lending them your money. They're just holding it for you. They actually hold it and it's segregated from their own money. So even if a Schwab or a Fidelity in the likely event goes out of business, your bonds and your stocks are not subject to the claims of their creditors. You'll just simply move them to another company. So you don't have the going out of business risk like a bank. And when you lend your money directly to the federal government, there's not any credit risk or default risk because the federal government's always going to pay you back because they can always print more money. So the safest thing you can do with your money is simply put it in short-term treasuries with a brokerage account, link it up to your bank account so that you can move money in between your bank account and your brokerage account as much as you want instantly, and just keep under $250K of cash in your bank and the rest in short-term treasuries. And as you need it in your bank, move it in your bank. And we're happy to help anyone who needs that, not only make higher interest than the bank, but have way less risk than putting your money in the bank. You don't have to worry about $250,000 limits of FDIC insurance because when you buy treasuries, it's unlimited federal protection. So if anyone needs help, let us know. Call us at 866-WEALTHY. Otherwise, do that with your own advisor or your own brokerage firm. Way better than keeping your money in the bank. Looking forward to speaking to you soon. Thanks for listening. Talk to you soon.